Welcome back. You're watching the market right here on ET Now, and you're going to be watching the Eveready management talk to us about their earnings. Amritanshu Khaitan, who's MD Eveready Industries, joins us to talk about their numbers. Mr. Khaitan, it's great to have you on the show. What went wrong on the EBITDA front in Q4? While margins have been compressing for the last few quarters, what led to the loss this quarter?
You see, for Eveready, I would like to actually concentrate on the full year number, because the fourth quarter per se is a very lean quarter for the core business of batteries and flashlights. And we still continue to up our investments in the new growth categories of appliance and lighting. That resulted in investments and expenses being high, while obviously the margins were not supported by the core business having a relatively lower turnover in the quarter. If you look at the gross margin of the company, we have seen about improvement of about 10% at quarter 4 level. It's more the operational expenses which were coupled with certain one-off charges for consultancy, which was done also to see how we can improve our overall cost efficiency of the company, which was spent in this quarter. So I think this is more a one-off quarter phenomenon. What is heartening is that after many quarters, we've been able to grow our top line by 15%, and I see that trend continuing in the coming year. With that happening, automatically the EBITDA growth and the profit growth will come back online from quarter 1 onwards.
So can this quarter be considered as an aberration, and would you be able to come back into black next quarter, or these higher expenses of new product rollouts will continue to bother you?
No, definitely the company will be in black going forward from quarter 1. It's just that in quarter 4 we had higher expenses this year as we continue to spend for the appliance category. If you see for the year as a whole, our EBITDA has dipped by about 25-30 crores, and that has been because of investments in the areas which I mentioned, as well as the strong raw material push which we saw in the battery category. Those work is already on the plan to how we can mitigate certain cost pressures, and with that happening, margins should be back on track going forward into next year.
A strong growth in the lighting segment continues. What was the growth in the LED business, and has the high base kicked in there?
So the lighting in category has done extremely well for the company. We have clocked a total revenue of about 350 crores for the year, and this is even after the CFL business virtually disappearing. The LED business is where the thrust is, but Eveready as a company has been concentrating only in the consumer lighting space. Going forward into FY20, we have already front-ended investments on entering the professional lighting space, which has impacted the overall margins of the company. That will yield business growth in the coming years. So I personally think the lighting business per se should continue to grow at a 20-30% CAGR growth next 2 years for the company, as we enter into the professional lighting space, which is 50% of the category.
Right. It's been very long since you've won any meaningful big orders from the government for lighting. What's the reason? And with the Saubhagya scheme and also the fact that it is an election year, can we expect better traction?
We are not concentrating on the low margin orders from the government at a national level. But yes, we have now entered the street light segment as well. The bulb segment margins are not healthy in the government orders, so only if Eveready gets an order at a decent margin would we like to take it. But I'm happy to report we have just won an order from the Calcutta Municipal Corporation of about 5 crores, and these are good value added orders. So if we get good street light orders at a local state level or at a national level, which is positive for the bottom line, we would take it.
Well, input cost of zinc have led to a impact on raw materials. How have you maneuvered that volatility in metal prices?
You see, being a consumer oriented company, we try and rationalize our prices as and when required when it comes to the cost pressures, and we continue to monitor that. Last year, obviously, there was a strong pressure on zinc, but we think it has seemed to have plateaued off. And going forward, our Assam plant investment will also start yielding in the fiscal benefits of lower GST rates as well as income tax benefit, which we should get in the coming financial year.
Seeing as it is on account of the new businesses that you have posted a loss, how did the new businesses perform? How long before your foray into confectionery and the joint venture with Universal Wellbeing starts contributing meaningfully to revenues and margins, you think?
On the new business front, the lighting business has been extremely profitable this year. Our plans is just virtually the 1.5 years of existence, and we were very conscious about the investments being put into the category. So this loss is something which is there, but as we scale up revenues, we will see that these losses come down. Confectionery is a very recent launch. I think by the time we go pan-India with our products, it will be July, August. So you should see meaningful contribution to the top line and bottom line going into the second half of this year. Regarding the joint venture, that's at a paperwork stage today. As and when the joint venture is finalized and we form the company, we will inform the stock exchange about it. But I see any meaningful business contribution coming in by FY20.
Yeah, Amritanshu, appreciate your time and thank you for joining us.